the future hidden inside old crises. Every financial crisis leaves behind wreckage, lost wealth, broken trust, hard lessons. But buried beneath that damage is something rarely discussed: direction. Because every time the system breaks, it quietly reveals what it is becoming. Crises are not merely destructive episodes to be endured and forgotten. They are transformative moments that reshape the financial architecture in ways that persist for decades. Each breakdown exposes vulnerabilities, forces adaptations, and establishes new norms that define how markets, institutions, and regulators interact going forward. To understand why this matters today, we have to look beyond the disasters themselves and focus on what followed them. Each collapse forced changes that reshaped behavior, incentives, and expectations. New rules emerged, old assumptions died, and the system, scarred but altered, moved forward in a different direction than before. The Great Depression produced the Securities and Exchange Commission and deposit insurance. The savings and loan crisis of the 1980s reshaped banking regulation. The 2008 financial crisis generated Dodd-Frank and transformed capital requirements. Each response encoded lessons that would influence decades of subsequent decision-making. At first, these changes looked reactive. Safeguards added here, controls tightened there. Each reform answered the last failure. But over time, a pattern formed. Crises were not just moments of correction. They were moments of design. They defined what risks were tolerated, what behaviors were rewarded, and what outcomes were considered unacceptable. The regulatory architecture that emerges from crisis is never neutral. It embodies choices about values, priorities, and acceptable trade-offs. These choices shape the evolutionary path of the entire financial system. The early signs were subtle. Markets adapted to new constraints. Institutions learned how to operate inside revised boundaries. Innovation bent around regulation rather than confronting it. What survived each crisis wasn't accidental. It was selected. The system evolved by pressure. Financial firms that could navigate the new regulatory landscape thrived. Those that could not disappeared or were absorbed. Business models adjusted to fit within permitted boundaries. The invisible hand of market selection worked within the visible constraints imposed by crisis-driven reform. This is a reveal beginning to surface. The future of finance is not planned in calm periods. It is carved during breakdowns. Every panic redraws a map. Every recovery sets new limits, and the direction chosen in those moments echoes long after fear fades. The choices made under duress, when political will is strongest and resistance weakest, establish trajectories that compound over time. What seems like emergency response in the moment becomes permanent infrastructure that shapes decades of subsequent development. Old crises did not just change rules, they changed priorities. And those priorities are still shaping what comes next. The emphasis on stability over growth, on transparency over efficiency, on systemic resilience over individual freedom. These value judgments were forged in crisis and persist long after the immediate danger passes. As time passed, the reforms born from crisis hardened into structure. What began as emergency response slowly became permanent architecture. Safeguards were normalized. Boundaries felt natural. The system adapted not by resisting these changes, but by incorporating them into everyday behavior. Stress tests became routine. Capital buffers became standard. Reporting requirements became expected. What once felt like extraordinary impositions gradually transformed into ordinary features of how finance operates. This adaptation shaped incentives in lasting ways. Institutions optimized within the new rules rather than questioning them. Risk-taking shifted to areas less visible. Innovation sought paths of least resistance. The system learned how to grow sideways when forward movement felt constrained. When regulations tightened in one area, activity migrated to less regulated sectors. When traditional banking faced stricter capital requirements, shadow banking expanded. The hydraulic pressure profit-seeking always finds outlets, redirecting flow around obstacles rather than eliminating the underlying pressures. Crucially, each crisis left behind not just protection, but preference. Preference for certain forms of stability. Preference for predictable outcomes. Preference for resilience over reach. These values became embedded, influencing decisions long after the original danger had passed. Risk managers internalized conservative assumptions. Boards demanded demonstrable prudence. Regulators rewarded caution. The collective psychology shifted, creating feedback loops that reinforced risk-averse behavior even when conditions improved. Markets reflected this evolution. Volatility declined. Failures became rarer, but so did extreme successes. Growth smoothed out. Breakthroughs arrived more cautiously. The system became better at surviving shocks, but less inclined to challenge itself. The trade-off between stability and dynamism became increasingly visible. Markets that rarely crashed also rarely soared. Institutions that could not fail also struggled to innovate boldly. The price of preventing disaster was reducing the possibility of extraordinary success. The emotional tension emerged from recognition. Stability had been achieved, but at the cost of narrowing possibilities. The future felt safer, but smaller. The question was no longer how to prevent the last crisis. It was whether the lessons learned were shaping a future capable of handling the next one. Had the system built genuine resilience or merely created the illusion of safety by suppressing symptoms, while underlying vulnerabilities accumulated in new forms? The reveal deepened. Crises did not just remove excess. They trained the system in how to behave afterward. And behavior, once learned, is hard to unlearn. Institutional memory persists through personnel, procedures, and culture. The executives who lived through a crisis carry those experiences into their future decision-making. The regulations written in response remain on the books long after circumstances change. The collective trauma shapes risk appetite across an entire generation of market participants. The deeper conflict emerged when the system began to encounter challenges that did not resemble past crises. New technologies, new business models, new forms of risk that did not fit neatly into old categories. The safeguards built from yesterday's failures offer protection, but not always relevance. Cryptocurrency markets operated outside traditional regulatory frameworks. Algorithmic trading created new forms of interconnection and contagion. Digital platforms concentrated systemic importance in non-bank institutions. The map drawn from previous crises did not match the terrain being traversed. Institutions struggled to interpret unfamiliar signals. Models calibrated on historical stress failed to capture emerging dynamics. Decision-makers relied on lessons learned from old collapses. Even as the environment shifted beneath them, the system was resilient, but sometimes in the wrong direction. Risk management focused on preventing the last disaster while remaining blind to novel threats. Regulations designed for traditional banking proved inadequate for shadow banking. Capital requirements calibrated for credit risk misconcentration in operational and cyber risk. This was the emotional peak. Not fear of collapse, but fear of misalignment. The realization that surviving the last crisis did not guarantee readiness for the next one, that the habits learned under pressure could become blind spots over time. The greatest danger was not that institutions had learned nothing from past crises, but that they had learned two specific lessons, creating a false sense of preparedness that masked genuine vulnerability to different kinds of shocks. Innovation exposed this tension sharply. New entrants operated outside traditional frameworks, unburdened by legacy rules but also less protected. Established institutions watched cautiously, unsure whether to adapt or defend. Risk was no longer concentrated in familiar places. It was diffused, reshaped, and harder to recognize. Fintech companies bypassed traditional banking infrastructure. Decentralized finance operated without intermediaries that regulators could supervise. The assumption that systemic risk could be managed by monitoring large institutions proved incomplete when risk was distributed across networks of smaller actors. The system faced a dilemma: rely too heavily on old lessons and risk becoming inflexible. Ignore them and risk repeating painful mistakes. The balance between memory and adaptation became the central challenge. How could the system preserve hard-won wisdom from past crises while remaining open to recognizing genuinely new threats? How could regulators maintain vigilance without stifling innovation? How could institutions demonstrate prudence without becoming paralyzed? Pressure mounted as gaps appeared. areas where regulation lagged behavior, spaces where innovation moved faster than oversight. The future was forming in the seams left behind by past crises. Digital assets evolved faster than regulatory frameworks could adapt. Cross-border capital flows exploited jurisdictional arbitrage. New financial instruments proliferated before anyone fully understood their systemic implications. The machinery of crisis response was designed for a world that was rapidly transforming. The buildup was unmistakable. The system had been shaped by history, but history was no longer a complete guide. Past performance, as every disclaimer notes, does not guarantee future results. The lessons from 1929, 2008, and other crises remain valuable but insufficient. New risks demanded new thinking. Yet the institutional apparatus remained largely oriented toward preventing past disasters rather than anticipating future ones. The question became urgent. Would the lessons of old crises illuminate the future or obscure it? Would the reforms that prevented the last crisis create blind spots that enabled the next? Would the system's confidence in its own resilience become a source of fragility? The resolution arrived with a shift in perspective rather than a single reform. The system began to recognize that lessons from past crises were guides, not blueprints. Memory was valuable, but only when paired with flexibility. Surviving the future would require more than repeating what had worked before. This realization emerged gradually, through accumulating evidence that the financial landscape had fundamentally changed and that old tools needed significant adaptation. The climax revealed a quiet truth. Old crises had shaped strength, but they had also shaped habit, and habits, left unexamined, can become constraints. The system needed to learn not just from failure, but from change, to treat resilience as something dynamic, not fixed. True resilience meant the capacity to recognize and respond to novel threats, not just the ability to withstand familiar shocks. It required updating mental models continuously rather than fighting the last war repeatedly. In response, thinking evolved. Policymakers focused less on recreating past safeguards and more on building adaptive ones. Institutions invested in understanding new risks rather than forcing them into old models. Oversight shifted toward monitoring behavior, not just balance sheets. The future was approached with curiosity instead of assumption. Regulators experimented with sandboxes that allow controlled innovation. Institutions developed scenario analysis, exploring unprecedented possibilities. The emphasis shifted from preventing specific outcomes to building general capacity for rapid response. The resolution reshaped trust. Confidence no longer came from believing crises would not happen again. It came from believing the system could recognize unfamiliar danger early enough to respond. Stability became forward-looking rather than retrospective. Trust depended not on the absence of risk, but on the demonstrated ability to detect and address emerging threats before they metastasized. This required maintaining humility about what was known and unknown, avoiding complacency that often follows periods of apparent stability. What endured was a powerful lesson. The future is not hidden inside old crises, because they predict what comes next. It is hidden because they reveal how systems learn, adapt, and sometimes overlearn. Progress depends on remembering, without becoming trapped by memory. The challenge is extracting wisdom from past experience while avoiding the trap of fighting the last war. Each crisis teaches something valuable, but the most important lesson may be recognizing the limits of what any single crisis can teach about the next one. Crises do not define the future by themselves. How we respond to them does. The choices made in the aftermath, what gets prioritized, what gets protected, what gets reformed, determine the trajectory more than the crisis itself. The same breakdown can lead to very different outcomes depending on how the lessons are interpreted and applied. And the next chapter is always being written, long before the next collapse arrives. The seeds of future crises are planted during periods of apparent calm. The decisions made today about regulation, innovation, and risk-taking shape the vulnerabilities that will or will not manifest tomorrow. The future emerges from countless small choices accumulating into large consequences. Sometimes the smallest shift in perspective becomes the beginning of a new future. Recognizing that resilience is dynamic rather than static, that lessons are provisional rather than permanent, that the map must be continuously redrawn rather than merely memorized. These conceptual shifts may matter more than any specific policy reform. The ultimate lesson from old crises is not which particular mistakes to avoid, but how to maintain the capacity for learning itself. The